That's probably room 1 that had the problem, probably. All right, so our next section on the Schedule A concerns state and local taxes. These are the types of taxes that we're really talking about. Personal property taxes. By personal property taxes, we mean tax on personal property. And you'll see that there's a distinction. It's not real property. It's not real estate. Personal property is anything that isn't real estate. So cars, boats, RVs, that sort of thing, is what they're talking about with regard to personal property taxes. And we'll talk about that more, that distinction more when we talk about depreciation as well. Local real estate property taxes. So this is real estate property taxes. Anything that's attached to the ground. Other state and local taxes, which could be income taxes. It could be sales taxes. If the state imposes any like excise type taxes, those types of things. Taxes that were paid to the state or to local jurisdictions. And then foreign taxes. So these are taxes that you had to pay because you had some sort of obligation to a foreign country. There are two different things that can be done with regard to foreign taxes. There's also a foreign tax credit, which we're going to talk about in a later chapter. For most folks, the foreign tax credit is more beneficial than the foreign tax deduction. So remember, we talked about the distinction between deductions and credits. Deductions, you're reducing your taxable income, so that means you're reducing a percentage of your tax, whereas a tax credit is reducing the tax directly. So it can be up to 100% tax reduction. So for most people, for foreign taxes, it's more beneficial to take the credit, but not always. So there is a limit to all of these taxes, though. All of the taxes included in this category cannot exceed $10,000 per return. Doesn't matter if you're single or married, it's $10,000 limit. So if you paid property taxes on your home and it was $5,000, and then you paid $7,000 in state income taxes, total of $12,000, sorry, you only get to deduct $10,000. That other $2,000 is gone. That was something new that was also introduced in the Tax Cuts and Jobs Act. I call it reconciliation. Tax Cuts and Jobs Act in 2017. So that changed. It used to be, and this was a highly politicized issue. It used to be there was no limit. Now, if you think about property taxes at all in this country, it all depends upon your jurisdiction. There are some states that don't have property taxes at all, also don't have sales taxes. But there are some states where property taxes are really high, super high. In Northeast, you could be looking at $10,000 to $20,000 a year in property taxes on just ordinary homes, which is a huge amount of money. So individuals in those jurisdictions, California as well, were getting a big tax cut because their property taxes were so high. Whereas individuals in other jurisdictions, I'm not going to use Iowa as an example because Iowa's kind of middle of the road, actually in the higher 50% as far as taxes go in the country. But some states where they didn't have property taxes or the property taxes were really low, then they weren't getting that deduction. So now the counter to that is they also weren't paying the high property taxes, right? Now to me, I would much rather not pay an expense than pay an expense and get a deduction for it. You're always going to be better off doing that. But there was this disparity, and so they capped it at $10,000. So the people in those jurisdictions were not very happy about that. But before, there was no limit. And you think about some of these estates that are ginormous, their property taxes are extraordinary every year, and they were getting a deduction for that. So essentially what it meant was also wealthier people were getting a bigger deduction but at the same time they were paying higher taxes. But anyway, that was a big to-do. They passed it, and so now the $10,000 limit for individuals applies to everything in that category. It's pretty easy to get up to $10,000. If you live in Iowa and own property in Iowa, I mean, this affected Iowans as well. So I guess there's a workaround. I didn't see this one. A workaround for pass-through entities, which we'll talk about what those are a little bit later. S corps, LLCs, partnerships, bypassing the 10,000 limit. I guess what they would do is that's interesting. So I suppose you could have your business own the property and then get a full deduction for it. Interesting. Okay, that's relatively new. Okay, so what are these things? Personal property taxes, like I said, it's anything that's not real estate. So your car, that's the most common one, especially in Iowa. Your registration fee, if you have a car that's under 12 years old in Iowa, a part of the registration fee that you pay every month is considered a value-added tax, ad valorem tax, and is deductible as a personal property tax on your tax return. Now, it has to be an ad valorem tax. It has to be based on the value of the vehicle, not the weight. Another way that a lot of states will impose this tax is based on the weight of the vehicle, because it's supposedly for wear and tear on the roads and everything. The heavier the vehicle, the more wear and tear on the roads, and so they're going to tax those vehicles more. The only part that's deductible is the part that is an ad valorem tax. So it's got to be based on the value of the property. Excuse me. Yeah.
Is that the purchase value or is it the book value?
That's as far as how they value it.
Yeah.
They've got a formula. It starts out with the purchase value, but then a percentage gets deducted every year that you own it until the 12th year, when the ad valorem part, the value part of it, goes away entirely, and it's just a flat fee.
Okay.
So if your vehicle is 12 years old or older, none of it is a value-added tax. None of it would be deductible. But it is going to start based on the purchase price of your vehicle. Yeah, and then go down as a percentage. Yeah. So when you pay that registration every year, there's a part of it that's based on the value. But there's also in Iowa a part of it that's based on weight. It's a very small part. When I was in practice, what we would do is essentially, there is a formula for it. You can look it up. The Iowa Department of Revenue puts out a calculation. It usually came out to about $16 of every vehicle was not ad valorem tax. So that's what we would generally do, is just subtract $16, and then the rest of it was a value added, unless the car was more than 12 years old. It used to be 10 years old, by the way. They changed that kind of recently. Also, that tax has to be imposed on an annual basis as well. So, let's see. So yeah, it doesn't really matter what they call it. Like in Iowa, they call it an annual registration fee, but by definition, that part of it is a value-added tax. So you can call it that. There are other, excuse me. So there can be some complications, as they mentioned, on jointly owned. Oh, they're talking about real property here. Sorry. How did they get to real property? Personal property taxes. All right. Well, property taxes on real estate are a little bit different. In that oftentimes it's jointly owned property, if it's a spouse, if it's, you know, jointly owned with spouses, that's one thing. But, you know, because they're probably filing jointly on their tax return, but if it's, say you own a piece of property with your aunt or with your mother or something, you've got two separate tax returns, you've got to figure out who exactly gets that deduction. And for property taxes, for property that is owned jointly, it depends on whether or not the owner is jointly and severally liable for those property taxes. So what that means, that's a legal term, that means that if you are responsible, each individual is responsible for 100% of the tax. So if the other person doesn't pay their share, you don't just pay 50% of it. You have to pay the full 100%. So you guys have to work it out, who's gonna pay what. So jointly and severally, if you are jointly and severally liable, there are different rules than if you are not jointly and severally liable, which means that legally, I'm only responsible for 50%, the other person's only responsible for 50%, or whatever percentage that we have come up with. So, if we are jointly and severally liable, then we get to deduct whatever we paid. If we paid 100%, we get to deduct 100% of it. If we paid 50%, we deduct 50% of it. If, however, we are not jointly and severally liable, let's say I'm responsible for 30% of the payment, but I pay 50%. I only get a deduction for the 30%. Because you have to both own the property and make the payment. So if either one of those things don't occur, then you don't get the deduction for it. Because you can't just make the payment on behalf of somebody else. You're essentially what you're doing there is you're making a payment for somebody else's ownership, and that part is not deductible. Does that make sense? Yeah, okay. You sure? Here's an example here. Jacob and Rami own a parcel of real estate with ownership interests 30% to Jacob, 70% to Rami. Jacob pays the entire $2,300 real estate tax. If they are jointly and severally liable, then Jacob gets to deduct the entire $2,300 because they could come after him for the whole amount, right? If they're not jointly and severally liable and he pays the $2,300, he's only going to get a deduction for 30% of that $2,300 because that wasn't his responsibility to pay. And there they calculated that out for you. There could be some tricky parts when you sell property during the year. And this here we're talking about real estate taxes. So because you have to both own and pay the tax, when you sell a piece of property, in Iowa, property taxes are always assessed in arrears. So I think, the end of September, there is a payment due, and there's 6-month payments. But the amount that's due is not for 2024. It's for like the first half of 2023. So in order to get a deduction for that payment, you have to have owned that property back in the first half of 2023. And you have to make the payment now. So what happens when you sell property in Iowa is there's this reconciliation. The seller will give the buyer credit for the amount of unpaid property taxes. Because they're going to have to pay property taxes at a point in the future for a time when they didn't own the home. Because it's a year and a half behind in its assessment. Well, if you have to both own and pay for the taxes in order to get that deduction, that creates a bit of a complication when it comes time to filing your tax return. So oftentimes in Iowa, and the example that they give in the book here is different from how it's done in Iowa. This isn't how it's done in Iowa. I'll go through this example for you just to kind of give you a little bit of specific example. But in Iowa, so when you sell that property, the buyer is given a credit because at some point in the future, they're gonna have to pay that property tax, but then when they ultimately pay that property tax, they don't get to deduct any money for it, or because of that payment. They don't get to deduct because they didn't own the property at the time that that tax was assessed. Does that make sense? It's a timing difference. You guys are all accountants. You've heard of timing differences, right? Yeah. So it's a timing difference. It's just like in Iowa, it's a big timing difference. So there's this whole calculation. If you do taxes and there's a sale of property, you got to do this whole calculation to figure out how much do they actually get to take as a deduction. Okay. So, or if they bought property during the year, the amount of property tax that was actually paid during the year may not belong to the person that owns that property now, right? So anyway, I'm not gonna go through this. I've talked about that enough. Unless anybody wants me to. Like I said, this isn't how it's done in Iowa, how they did it here. What they did was they divvied up based on the number of days of the year. I guess I'll go through it. Okay, so David sold some land to Moesha. Tax was $3,300, and it was not due until August. So March 1st is when David sold the land to her. If David still owned that, he'd be paying it in August, but he didn't own it in August. But he still owes taxes that he's gonna have to then give to Moesha. So how much of anything can David and Moesha deduct? In this case, the buyer and seller will prorate the real estate tax on a daily basis. David would deduct $533, so if it was March 1st, it would have been 59 days. He gets that much of a deduction. Moesha gets to deduct the remainder of $2,767. Day of sale is not included in David's holding period. So like I said, this is not how it's done in Iowa. It's not that simple as dividing it by the number of days because of that timing difference that goes on. This is real estate taxes. So real estate taxes are deductible. This is for personal property. We're not talking about business property in this part. So personal property is your personal residence for the most part, or any property that you own personally. So you're not gonna be using it for any business purposes. So principal residence, any personal use property. So if you've got a second home as well, that would be considered personal property. And it doesn't matter how many homes, you can have a bunch of homes. If you're paying taxes on them, it would be included, but remember in this category, you're limited to $10,000, right? All right, so if it's rental real estate though, say you own a home and you rent out that home, that is a separate category of expense that's considered rental real estate income and expense. It's going to go on what's called a Schedule E. We're going to talk about that in chapter 8. That does not have a limit to the amount. It goes on a separate tax form. So it's important to make the distinction and to know what the purpose of the property is. Just because it's property taxes doesn't mean it goes on Schedule A. Depends on how it's being used. If it's property that's owned by a business, it may go on a business return or on a Schedule C. If it's property that's owned as rental income or rental real estate, then that's going to go on a Schedule E and it's going to be 100% deductible. In this case, we're just talking about personal use property as opposed to personal property. Okay, personal use property. Now, personal use real estate is property that you are using personally for it. So usually what happens with property taxes, a lot of people will pay their property taxes on a monthly basis through their mortgage company. So it's called an escrow account. The mortgage company will collect on a monthly basis the amount that they think is going to be due for those property taxes. Even though the property taxes themselves are due twice a year, they will collect it on a monthly basis, and then when it comes time to pay it, they'll make the payment to the county treasurer. The deduction is not the amount of monthly payment that goes into that escrow account. The deduction is the amount that the escrow, or that the mortgage company actually pays. So here we got an example. Monthly mortgage payment is at $1,500. Of that, $1,250 is principal and interest, and $250 is for real estate property taxes. Every month, the mortgage company deposits $250 into an escrow account. November 2023, the mortgage company paid the actual tax bill of $2,800. Miriam gets to deduct $2,800 on her 2023 tax return. So even though she paid, what is it, $3,000 in there, she only gets a deduction of $2,800 for it, because that's how much they paid. That additional $200 that they collected will stay in that account, and then it will lower her monthly payment next year, or what they collect next year. All right. State and local taxes. So this is income taxes. So however much you pay in income taxes to the state during the year can be a deduction up to that $10,000 limit on your federal income tax return. Now it's only state and local. You don't get a deduction for federal income taxes that are paid. So for example, Elijah in South Carolina, state taxable income $120,000. His income tax, his state income tax is $7,200. He would get a deduction as long as that's what he paid. Again, this is based on how much you paid in, not how much you actually owed, but how much you paid, how much cash went out. Gets a deduction on Schedule A, and we get a deduction for that as long as everything within that category is within the $10,000 limit. So where do you pay these taxes? Most people it's through withholding. So the total amount of withholding on the W-2 at the end of the year. It could be through estimated tax payments that were made to the state. It could be that you had tax due when you filed your tax return, and then you get a tax deduction as well. You do have to offset that. So this is the reason why those state refunds can be taxable, because you paid this money in, but if you ended up, and you get a deduction for it on your Schedule A, if you ended up getting a refund from that money that you had paid in, then you may have to pay tax on the amount of the refund. So it works with that state income tax refund income that we talked about in the last chapter, or in chapter 3. Everybody remember that calculation? You had a choice between the actual amount, or the amount over and above, the actual amount of the refund, or the amount over and above what was itemized. Remember that part? It works with this. Let's see. You guys are all starting to look kind of glazed over, so I'm gonna, excuse me. I'm not gonna talk about California. Anyway, all of these taxes, you can see how it's really easy to exceed that $10,000, because state income taxes and property taxes alone are probably gonna send most people over that threshold. Foreign taxes, again, as I mentioned, are also deductible, but the credit is usually more advantageous. So these could be foreign income taxes, foreign property taxes as well. So if you own property in a foreign country, you may have to pay property taxes on it. So this is actually an example of how the credit is probably more advantageous. U.S. citizen and resident, several investments in England. Investments produce substantial income. He had to pay $3,500 in British income taxes. Assume that his effective U.S. federal tax rate is 35%. He has a choice. He can file Form 1116, which is the foreign tax credit form, take a $3,500 credit for the British tax that was paid, assuming that the foreign tax credit limitation does not apply, or he could deduct the taxes on Schedule A as an itemized deduction. The credit is gonna reduce his taxes by the full amount of $3,500. So dollar for dollar reduction. Whereas the deduction is only gonna save him $1,225 in taxes because it's a percentage of the amount that he actually paid. You can't take the credit and the deduction for the same expense. You have to have documentation for all of this. Usually that's not a problem. For the taxes paid, like as far as, well, for real estate taxes, of course, you can print that stuff off online. That's what we would do, like with clients. There's this website where you can go and look up property. You can look up anybody's property taxes, by the way. You can see how much they paid for their home. You can see all that stuff, when it was purchased, all that stuff. If you're the nosy type and you want to look it up, you're curious, you can do that. So you can get that stuff online and use that as the substantiation for income taxes paid. Obviously, W-2s or estimated tax vouchers, that sort of thing, would be sufficient. Could be a little bit trickier with regard to foreign income, but these are some sources of substantiation there. What is all this? Oh, that's just a summary then of the different substantiation. All right. Again, within that category, it's limited to $10,000 of all those types of taxes.